Liquidity analysis. Please remember, as professionals, for any business that we need to analyze for any purpose, as we have discussed earlier, as we have discussed earlier, so any business that we need to analyze, besides profitability, we also need to look at the liquidity. How do you find out the liquidity? We will find out the liquidity by calculating two ratios. One is known as current ratio. And how do we calculate the current ratio? Current ratio is current assets divided by current liabilities. And then you have a modified version of current ratio, that is known as quick ratio. I am sure all of you must be aware in any case as to what is current ratio and what is quick ratio. The quick ratio is current assets minus inventories, dividing it by the current liabilities. That gives us the quick ratio. One thing that I would like to mention here, to differentiate between the current assets and the working capital. Please remember, the current assets and working capital are not same, because working capital will mean only those assets which are used in running of the business, and that's your working capital. Whereas the current assets can include certain assets which are not really your working capital. So say for example, if a company has made investment into the shares and debentures of another company with an intent to dispose that off as soon as the share price goes up. Now remember, it is current assets, but it is not part of your working capital. And why it is not part of your working capital? Because this investment that you have made into the shares or debentures of some other company is not going to help you in your operations. And this is how you would look at your liquidity analysis. After the liquidity analysis, then you look at the solvency ratio, solvency analysis. So how do you do the solvency analysis?